Hi class, I'm Kelly Still Nichols. I am pleased to be your professor for Accounting 209. I appreciate your patience as we launch this new textbook. It's the first time I've used this book, so I'm still getting familiar with the resources. I apologize for kind of the confusing assignments I made, but we're all having to learn how to use the supplements that come with the book. So today I want to work through, this video is going to be exercise for chapter 1, exercise 1-13. Now, one of the key things that we have to get good at in chapter 1 is kind of understanding how the balance sheet pulls everything together. Accounting really has not fundamentally changed since the 1500s, when it was basically passed down from one Venice merchant to another. So if I was a merchant in Venice, I would go down to the shipyard in the morning. Let's just say I would buy 10 rugs at $10 each. So I'd buy 10 rugs at $10. So I would spend $100. So what would happen is I would spend $100, but I would now have $100 worth of inventory. So I spent one asset to get another asset. Then I go to the market. And when I go to the market, I sell, let's say I sell a rug for $20. Well, that rug, so I take in $20 and I give up a $10 rug. So I have actually increased my wealth. I have increased my wealth by $10, which means my equity has gone up. Okay, so those Venice merchants, when they went home from the market every night, they knew where they were. They knew if they were up, if they were wealthier after the end of that day than they were when they started. In other words, they know if their business made money. Okay? So what we're going to do, let me see if I can get rid of this without just making it a big, horrible, smeary mess. Probably not. And we will do our best to work through exercise 113, and I think you will be pleased with how you immediately in this chapter jump into understanding how transactions, that's what we're trying to get good at in these first 4 chapters, how transactions of the business get recorded and are reflected properly. Okay? So you need to set up your work paper like this one, where you've got assets equals liabilities plus equity. Okay? So in other words, everything I have, I either got it because I put money into the company or I borrowed the money. Okay? That's why assets equals. All my assets are either financed because I borrowed money to buy some equipment or something, or I put money in the business and then I made money in the business, which I then spent to acquire assets. So that's the whole idea. Assets equals liabilities plus equity. All right, so what we're going to do is, instead of writing out journal entries, which we will do that next chapter, what we're going to do is just work through these transactions and put them up on the board the way they affect the accounting equation, which is the balance sheet. Okay? So Min Chen began a professional practice on June 1st and plans to prepare financial statements at the end of each month. During June, Ming Chen, the owner, completed these transactions. The owner invested $60,000 cash in the company, along with equipment that had a $15,000 market value, in exchange for common stock. So, he's a corporation. He's starting a corporation. He puts money into the corporate bank account as an investment, and then he now owns the stock of the company. Okay? So, we are up $60,000 in cash, and we are up $15,000 in equipment. which means that Ming Shen issues himself $75,000 in common stock. See how these balance? Okay? All right. The company paid $1,500 cash for rent of office space for the month. Okay, so we're going to write a check for $1,500, and that is an expense of our business. So see, that reduces equity. We reduce the wealth of our firm because we're taking an expense against any revenues that we make and against the equity of the firm. The company purchased $10,000 of additional equipment on credit. Okay, so what that means is that we went and purchased equipment and we're going to pay them later. When somebody says they purchase on credit, it means that they took the stuff home, the company bills them, and they will pay it later, okay? So we're up another $10,000 in equipment, but guess what? We're up $10,000 in liabilities. We're up in accounts payable. We owe somebody for that equipment, okay? The company completed work for a client and immediately collected the $2,500 cash earned. Okay, well that's a good deal, okay? So that means that our client paid us. It's really hot in these lights. That means that our client immediately paid us. So we gave them a bill and they paid us on the spot. So we're going to be up $2,500 on cash and we're going to be up $2,500 on revenue. Okay? The company completed work for a client and sent a bill for $8,000 to be received within 30 days. So, like let's say I'm an architect, okay? I finish some plans for someone. They come pick them up. We give them a bill for $8,000. They go home and stick it in their bills to be paid file, and they pay us later. So that amount is receivable by us. We are going to receive that from them. So we are up $8,000 in accounts receivable, and we are up $8,000 in revenue. Just because we haven't been paid yet doesn't mean we haven't earned it, okay? The company purchased additional equipment for $6,000 in cash. Okay, well that means we wrote a check for $6,000, but we're up in equipment. So that was just one asset swap for another. So see, this is zero and there's nothing over here, so it still balances. The company paid an assistant $3,000 cash as wages for the month. Okay, so again, we wrote a check for $3,000, and that was to pay an expense. Okay? The company collected $5,000 cash as a partial payment for the amount owed by the client in transaction E. Okay, so up here we billed our client for $8,000. Well, apparently they paid us part of it. So we're up $5,000 in cash and we're down $5,000 in accounts receivable, right? Okay. Excuse me. The company paid $10,000 cash to settle the liability created in transaction C. So up here we bought equipment on credit and now we're going to pay this bill. So we're going to be down in cash $10,000, but we're also reducing our liabilities. So that's good. So see, even effect on both sides of the equal sign. Okay? The company paid $1,000 cash in dividends to the owner. Okay, well, dividends are when the company pays to the owner something they already own. That's why it's not an expense. It's a dividend. Okay, when you're the owner and you take money out of the company, which represents a return of its earnings, you already own that. Okay, so we're going to write a check for $1,000, and it's gonna be in dividends, and dividends reduce the equity of the firm, okay? So if we did all these correctly, then when we add up the columns, they will equal each other, okay, on both sides of the equal sign. Okay, so cash, I believe, should add up to 46,000. You can double check me on that. We've only got 3,000 left in accounts receivable, and we've got 15, 10, 6. We've got 31,000 in equipment. Okay, so that'd be 46, 49 plus 31 would be 80,000, right? Okay, here we have 0 in accounts payable. We have 75,000 in common stock, minus 1,000 in dividends, plus 10,500 in revenue, minus 4,500 in expenses. So 75 minus 1 would be 74. 10,500 minus 4,500 would be 6,000. So 74 plus 6, yes, both sides equal 80. So we must have recorded these all properly. Okay, thanks.